So I just thought I'd pop in, do another market charting video, try to see where we are at in the market. As you can see, today's been a pretty red day, pretty brutal day. We're in the midst of a correction. And I want to see, okay, is this just a run-of-the-mill correction or is this something bigger? And so we're just going to look through the charts and see what we find. I think I kind of have an idea and we'll see, how that plays out. Starting with a yield curve, this is the 10-year minus the 2-year yield. As you can see, it's been consolidating since October of last year. A couple weeks ago, it started to break out, but this week, especially today, we've had a huge move up. And, at this pace, we're maybe a week or two away from a de-inversion of the yield curve. If that happens, well, okay. Generally, that's sort of saying really bad things are happening in the economy. People are starting to realize how bad things are, and they're starting to trade based on that. It doesn't always happen right when the market really gets bad, but it happens around that period, plus or minus 3 to 6 months. So that's generally what we've seen in the past. But this is the longest yield curve inversion in at least the past 50 to 100 years. So it'll be interesting to see what happens when it de-inverts. I think this is a big deal when the de-inversion finally happens. And I think it looks like it's set up to happen fairly powerfully. We have had this bull flag that's, basically lasted almost a year, like 8, 9 months, something like that. And when this goes, I think it's going to go fairly strong. Going to the 10-year yield, you can see what's happening here. Basically, it's been roughly following this channel up. Since I guess throughout 2024, it's maintained a fairly steady range between 4 and 4.6, 4.7%. What I see on this, let's just get rid of some of these. Not that, but some of these lines that aren't really useful anymore. What I kind of see is a head and shoulders formation somewhere along this pink channel. If this breaks, I think it's going to make its way down to the bottom of this bigger channel, unconfirmed channel, because we don't have enough points, but I think it's going to come around somewhere around the 3.5% mark. And there's several reasons for that. One is in a potential channel. Two, you project down from the channel, like sort of the head and shoulders range. It'll be around there. And then three, you've got sort of a trend line going back to 2014 that kind of makes a nice landing point for that to come down to. If it comes down to 3.5% fairly rapidly, that's going to mean people are flocking to bonds, and so I think that will mean things are breaking in the economy because usually fast moves in markets, especially bond markets, usually mean bad things are happening in the economy. People are moving fast to reposition. If you go to the US 2-year yield, same thing essentially. Although when this breaks, I think it's going to be a much more dramatic break, close to 0% again. I'm not sure how low it can go. Like you can see, I guess since 1989, I think this goes further back, but this descending sort of line that's been held for, from 89 to 2022, we're out of that. And so when this breaks down, I think it could probably, maybe not go down to 0% again, but 1 to 2%. But generally what happens when you have these rapid flush downs in the yield curve or in the 2-year yield or the nearer term bonds is, bad things are happening in the economy. Again, like panicking, rushing into short-term bonds. And the Fed, it could also have to do with the Fed funds rate. The Fed funds rate has more control over shorter term bond yields than longer term bond yields. And so I think we can just look. Yeah, they're at 5.3%. So they're actually a higher rate than the 2-year yield. So if they drop the rate rapidly, then shorter term yields follow. I'm not sure what drives yields the most. I just know they make these moves around times of economic turmoil. And I think fundamentally that's kind of happening in the economy. Things are slowing down. Things are not looking so great. You ask anyone on the streets, your average blue collar worker or even your average white collar worker who doesn't have a lot of money, they're probably not going to be loving the economy right now. I also want to look at, okay, so we can look at TLT first and just show like some background. TLT has been in this falling sort of channel-ish. I don't know if it's good enough to call it a channel, but it's been sloping downwards for a while. But recently, I think it's broken the downtrend at least for a while. So we'll see if this continues its upward momentum. I think if it breaks to the downside here, then it has further to go down, which would be interesting because usually usually in an economic crisis people rush to longer term bonds because the payoff is higher when the yield changes. The value in the bonds goes up more for longer term bonds than shorter term bonds. So this will be like a change from what normally happens if we head into an economic crisis and this flushes down instead of up. Um, that would be a big change. So like my expectation is kind of that it continues in an uptrend. This channel isn't really valid. I just put that there. Just, I guess scenario casting. Something that might be more realistic might be something like this as a possible trend line. I think it's too early to really tell what the trend line is, but it's kind of sloping upwards. And we could watch that. Junk bonds are kind of the highest risk bonds, and you can see, let's go monthly chart just to see the long-term trend. This is a junk bond ETF, so it kind of tracks the junk bonds just like TLT tracks the long-term treasury yields or treasury bond prices. So we've been doing kind of well in junk bonds, and you can see recently it's broken out after a long consolidation, I guess a consolidation throughout all of 2024. Here's the issue though, it's kind of instantly coming back down. So is it just back testing? And this is kind of bull flag to continue up. If it does that, then I think things are probably, it's a sign that things are fine in the market for a while longer. If this breaks down, I think that's a really bad sign, because it's had all this time to consolidate. It finally breaks out. If there's no buyers, at the breakout, that's, I think, a bad sign, and it's probably going to lead to a panic, and the actual move is going to be the opposite direction. So this is something to watch carefully. Right now, nothing really to worry about, but you're at that inflection point. All right, going over to the S&P Futures Index. We've been in a very, very strong uptrend up until, well, the last 2 weeks, really. And this trend line that we've been in, actually so there's two key trend lines that broke. One was this kind of longer term trend line. We broke above it briefly and then we broke down. That's usually a bad sign. If it, that's a false breakout to the upside, usually that's a bad sign. Means the actual move is going to be in the opposite direction. Usually not 100% of the time, but it's good enough from my experience to be worth betting on it or making a trade if it does break in the opposite direction. And if you did go in short down here, you're probably doing pretty well right now. The other trend line it broke was the secondary, like the lower trend line of this rising wedge. So the fact that it broke both of those trend lines, I think that means a bigger correction is coming. My base case right now, honestly, might be down to this longer term trend channel line, this big thick black line, which has most of the time held, obviously in big sort of crisis type scenarios, the 2018, 2020, we broke below, but for general purposes, this has held pretty well. Obviously, since I guess 2021, it's not been respected that much. So my base case is we come down to this line. The fact that it's been invalidated so many times up here probably tells me it's not so reliable. It might be time to look for another, the next trend line whenever that happens. But I think this has a fair ways down to go just by the fact that it broke these two trend lines. If you go to the VIX, which is market volatility, you can see we've pretty much held this trend line since, I guess the first strike was October of 2022. So really since the end of the bear market. The market, I think, bottomed or was close to a bottom in October 2022. Like it made a bottom or a double bottom in 2022. Since then, we've been basically sloping downward. Volatility has been going down continuously, meaning insurance has been getting cheaper because less people want it. And recently we broke out. So one thing to notice is I'm not sure if this is just a glitch of TradingView, the data that they got, but this is really unusual, this long wick. And if you go into to see where that happened, yeah, something really weird happened here. I'm not sure. I wonder if that had to do with it was 2:30 p.m. on Friday, my time, which would be like 4:30 Eastern time. I don't really have an explanation for that long wick on the VIX. But it's an interesting coincidence that it happened right before a breakout. I will say that. And it does look like the VIX has bottomed for a long time. A few candles down here that have sort of broken below the consolidation range. But then it recovered right away. The VIX has broken out once before, and that ended up being a false breakout. You can see the market opened with the VIX up high and then immediately flushed down. This time, things are a little bit different. It did the first test of this trend line, and then it broke out with the market closing with the VIX above this trend line. So that's a little bit more reliable, but obviously I think it's got 1 to 2 days to turn around and come back down. If it does do that, I think that's kind of an all clear sign for the market, at least for now. And then if it does that, then I would be looking I think we would still be in danger. If I can find what I'm looking for. Yeah, okay. If it comes back down, if it kind of consolidates like this, I think we would still be in danger of a breakout in the VIX eventually. But it would be delayed maybe for a month or so, maybe a few weeks to a month. So this is another thing. Right now it's saying this is bad. Be wary. The sell-off that we're getting might not just be a run-of-the-mill sell-off. It might be something much bigger. Another chart to look at, the NASDAQ futures. This guy has done something similar to the S&P in that, this has done something similar to the S&P in that it's been in a strong uptrend. It's been following this rising wedge. It broke out to the upside and then it broke back down. So that's a false breakout. It hasn't broken down to the bottom of to the bottom of this wedge. It also has kind of this long-term trend channel, the upper border of that channel as support. So right now, I really would be curious to see if in the next few days, I would want to see kind of a strong rebound to be a bullish sign in the market, is almost erasing this red candle that came today in 1 to 2 days. If it consolidates and goes sideways, that would be kind of like, I would take that as a bear flag and kind of expect more downside to come. If it breaks right through, like tomorrow we just get another big red day, then that I think means we're panicking in the market. So that's something to watch as well. All right, Dow Jones. This one is concerning to me because, actually, can we just go? There's two different Dow Jones charts. I'm not sure what's going on there. I guess two different data sources. The Dow Jones has consolidated really since March of this year. It finally broke out, almost immediately broke back down. That to me is a really bad sign. And that turns this from a consolidation and breakout to go higher to a topping pattern. And a much more reliable topping pattern than if you didn't get that false breakout. So this has me very concerned about the Dow. IWM, we almost had the same thing happen to the IWM. It looks kind of like a top on the daily chart where you have a high, lower high, kind of stalled out right after breaking out. But this isn't enough to say it's a false breakout because it hasn't broken back into the consolidation range. So I would say right now, IWM is looking better than the Dow Jones. If it comes back, it's hard for me to tell where the most likely area for a retest would be. Maybe I would put it down like right around here, so 210-ish. If it comes back for a retest around 210 and then continues moving up, I would say that's pretty bullish for the IWM. In fact, if it comes down here, it might even be an objective area to go long if the rest of the market looks okay by that time. I think that would be a sign of strength. But if it breaks back down under that consolidation area, then I would be afraid for the IWM. Okay, industrials. Another one that I think has had a false breakout. You can see two tests of the sort of trend line. I know you usually need 3 tests of a trend line to be considered a trend line, but you could just as easily consider this as horizontal support resistance. It broke out and then almost very quickly broke back down, or after a week or so broke back down. So same thing as with the Dow Jones, is kind of what I would call a false breakout. Okay, IWF, the growth ETF, this is kind of the same picture, only, you can see how these two tops probably are about the same time as the two tops in the other chart. They're just sloped upwards because this ETF at least has been a lot stronger than much of the other ETFs, but it also looks like this one has had a false breakout. I think this is probably too close to tell for sure. You definitely have some wiggle room to say, okay, it hasn't been a false breakout yet, but it's something I'd watch for. Again, consolidation at this area, and I would probably expect a breakdown. If it bounces right off, then to me that's a strong signal, at least looking at this chart in isolation. Okay, the value ETF looks almost the same as like the Dow Jones or the others. Potential false breakout. This again is too close to tell. We're right at consolidation. So, if you're bullish the market, this might be the place to go long on this chart at least. XLI, industrials, I think this is a pretty clear false breakout. At this point, it looks almost like we're seeing the same chart over again, just in different flavors, which I guess in some sense we are. XLB, false breakout. You can see the consolidation, tries to break out, fails after a few days. XLP, this is consumer staples. It looks like this, yeah, you can't really tell. This looks like it recovered, it like saved itself. So this might be a buy here in isolation for this chart because it broke out, broke back down. Now it's starting to look more like a bull flag pattern. Okay, XLY, consumer discretionary. This, I think, is Tesla has pretty much destroyed this chart by itself. Huge gap down today in Tesla, which translates pretty strongly to consumer discretionary ETF. But again, it's kind of been a rising wedge, little false breakout and then a breakdown. So I would take that as a bearish sign. Technology ETF, same kind of thing as the triple Qs or the NASDAQ. False breakout and then breakdown. If you extend this out, still has some room to go before the lower trend line. So stand by on this one. Okay, moving over to, let's go XLF. This is the financial sector. Again, looks like a false breakout. Same pattern as we've seen over and over again. Okay, now let's move over to a little bit of energy. Gotta love this wick still messing up charts 4 years later. Okay, crude oil, there's not a lot to say here, really. I'm neutral this. If it like the pretty much the areas like the line in the sand is this upper purple trend line. If it breaks out, then super bullish. If it breaks below this lower purple trend line, then super bearish. I can't really say anything yet on this. What I can say, okay, XOP, what I can see on the XOP is that it looked like, okay, triangle slash pendant consolidation, breakout, and then a false breakout. And you can see we even made a second attempt to break out of this, like if you could call this a bull flag pattern. It tried to break out of the bull flag pattern and it failed. So I would say that's pretty much nail in the coffin for XOP. I kind of expect it to break down to the bottom side, or to the, through the bottom of this pendant here now. XLE looks a little bit different, more of an upward sloping. Again, these trend lines are not the cleanest on this one. It's really hard to make out, okay, which trend line do I pay attention to? Maybe if you to start over, I would probably call this the trend line to pay attention to, at least on the lower side. The upper side, obviously this trend line, not much to say here, I don't think. Because it's in the middle of the range, I would say it's almost a dice roll which direction it goes next. You could probably go on a lower time frame chart and say, okay, it's consolidating sideways along this line. If it breaks down, then we're probably going to go to the bottom. But again, okay, I don't have a strong opinion on energy, I guess, is what I can get out of those charts. Let's go down and at least look at some commodities, pretty much just the metals, because I don't care too much about the softs or the agriculturals. Copper is looking bad. You can see beginning of the year, it broke out, had a very nice run. If this were to be bullish, my expectation would be it would keep going sideways in this range. It did not do that. It broke down, basically straight up, straight down, gave a little rebound, and then straight down again. So I almost, obviously I can't tell when this is going to bottom, but my expectation at this point, I think, is that we have a retest. So that's a pretty big drop in copper from here, 15%, at least doing a retest of this breakout trend line. That at least tells you the economy is not doing great. It could even retest this very long-term trend line from 2009, although it kind of was messed up by this COVID drop. So we'll see. Right now, I'm pretty much bearish on copper, and I think you'll see a similar story for these other industrial metals. Zinc had a nice bottom back here, end of last year, early this year, had a big rip, and it's kind of giving a double top, which that's typically bearish. So my expectation is we'll see this roll over and then maybe come back down for another retest. The steel ETF, we've had a long consolidation period since 2021, and it's been kind of just climbing this trend line, but it's broken, and this looks like a bear flag after the break. So this looks like a great, at least at the back test here, would have been a great entry short position for SLX, because I do expect it to go much lower from here. Nickel, gosh, I don't know how accurate nickel futures are, but we're breaking below this kind of trend line that we've been, whether you put it here or here, I would say we're breaking below the long-term trend line since 2017. I think this is going quite a bit lower. Nickel is. There's Alcoa, which is a copper, aluminum based stock. If you look at the aluminum futures themselves, I can't even tell what's going on here, so we'll just skip over that. Gold looks, it's hard to read gold right now. This is just consolidation. When it breaks out of this consolidation, that will tell us whether it was a bull flag or a topping formation, pretty much. These are the types of things that are hard for me to read. What I will say, and I think is important to note, is when you see strong flush downs like this, buying little by little, and then strong flush down, buying little by little by little, then strong flush down, I would say that's big, big money getting out, because they have to get out in increments. This looks like the sort of distribution, right? Little, small money, retail traders, hedge funds buy a little bit at a time, and then someone's wanting to get out, so big flush down. So that's all I have to say on gold. Is I'm kind of biased towards this being a short-term top, and then gold would come probably flush down around the $2,000 level again. I do think the $2,000 level is going to be a very strong floor going forward. If it flushes below, it's going to be like, I think, a very, very short thing, and that would mean we're in major crisis mode. Silver, a similar thing. I almost say that bearish case for this is much stronger, because we sort of have this, a diagonal head and shoulders here, and then a clear break of the trend line. I'm not sure where this stops. Probably, okay, so it potentially stops here. Like, we're at potential support right now. Well, not potential, we are at support right now, right? We have one reaction, many reactions from 2020, 2021, and then it looks like support from the bottom of the 2011 sort of consolidation area. So good good chance we bounce here where we're at right now. After that, we'll have to see. If it continues to look weak, then maybe a flush down to this longer consolidation trend line pre-breakout, and that could put us down, $24 or so for silver. So yeah, it's hard to give a strong opinion right now because we've already had a big flush down. We're kind of in that middle neutral zone where, you kind of if then react. At least that's my approach to it is. Okay, I think we can look at some ratio charts because I always like to look at these. The important ones I think are going to be the S&P to money supply chart. This is important because it's the chart that kind of shows where we're at in comparison to the dot-com bubble. You can see we really went up to like 2.71, which here was a potential area where I expected to get rejected. Why did I expect that? Was because you got, it's basically the closest level of resistance that we had between these two major areas. And it looks like we got that so far. And not only did we get that, shorter term, this pretty much just shows the trend lines already shown on the S&P chart. But we could probably have, if you want to talk about like where we stop, anywhere between 5 and 15% lower. This area right here looks like a potential area for support, maybe even here. But then below that, I think we just do a quick flush down to the 219 area, which would be, I think, major support. And it's going to be hard to break below that. So short term, I expect at least a little bit more downside, at least a couple more red days. Long term, we'll have to see if this ends up being a longer term top. NASDAQ to money supply, I think this is more. This is definitely a chart that tells you it's time to be worried. And that's because, okay, this chart goes from 2010 all the way to the present. We haven't hit this trend line since November of 2021. And the last time we hit it, it was the beginning of the bear market. Every time we hit this, there's at least some downside, whether it be COVID levels or 2022 bear market levels of downside, or just, tap it, go up higher, tap it again, correct, kind of hugging this trend line, if you will. So this is what we'll be looking at, is whether we're hugging this trend line or whether we get a stronger flush down. Now, this chart alone doesn't tell you which to expect. Other than that, if you haven't touched it for a while, then usually that's a fairly aggressive move down. Well, actually, I can't even say that. So yeah, this just chart just says we're kind of overvalued in the market. It's due for a correction. And that's what we've seen in the last 2 weeks. So we're a little behind on using that as an indicator. All right, IDOUM to SPX. This kind of like nailed the day of the big breakout in the IDOUM. You can see how there was a double bottom, and then like this was the day of the breakout. And it very quickly has moved to the top of this trend line, or this rising wedge, falling wedge. And we're at the top. So again, the question is, does this top here and then come back down? It almost looks like we're kind of slightly higher high, so it kind of looks like a topping pattern here. And so maybe we'll see this roll over and go back down again. For this to break out, that's something I would like to see, is like maybe a double bottom. This rolls over, comes back down, double bottoms. Maybe that even marks the end of the correction. And then it breaks out, and then, it's off to the races in the market again. At least, yeah, that's one potential area I would look for a bottom in the market, is if we see a double bottom on this chart. And if we do see that, then I think I expect a breakout in this falling wedge. And that's probably good for the market overall, because IWM means risk on in general, means lower interest rate expectations. So maybe we see the great sort of rotation continue from larger caps to smaller caps. Gold to S&P. Yeah, we're kind of just moving over to comparing to the S&P. You can see that gold has sort of like, this is just a massive bottoming pattern if you ask me, and it's just been going on forever. But we're kind of moving away from this downtrend line. So I think the outperformance of gold versus the S&P 500 is just about to start. Like, this is potential inverse head and shoulders here. We're seeing positive momentum. I think that's going to accelerate as this transitions from a very long, decade-long downtrend to, at least a few years of an uptrend. And let's see. NASDAQ to S&P. This, I think, is another important chart. Let's just go to the one on the watch list. This basically timed the top of the market within like a couple days, based on this trend line that was extruded or extended from here. To me, this looks like we already had a breakdown of the consolidation range, and then it break back in. I have no idea what it does next. At least I don't have a good indicator of direction. What I can say is if it breaks to the upside, that's mega bullish for large caps at least. And then if it breaks to the downside, that's mega bearish. That's my expectation based on this chart. So continue to watch. If it sits here, consolidates, breaks down, that's a huge deal, I think. And the same as if it, ends up at the top of that trend line at some point. Okay, okay, gold to silver ratio. This has been in consolidation since December 2022, or maybe even arguably September. It broke down from this consolidation area, and now it's back testing it. So this is sort of the do or die area. If it breaks back in, then we could see an insane gold to silver ratio. Like, I would expect this to keep going at least up to the high 90s, if not, back to the, level we saw in March 2020. And this, I think, is a huge indicator for the strength of, or like the sentiment of the market. Silver leading usually means risk on mentality for the market. Silver lagging, or gold outperforming silver, at least to this extent, usually means bad things for the market. Like look what happened in 2020 crash. Huge skew in that ratio. So I think this is important to watch. Like, we're a very important area right now. So if you're bullish gold and silver, you need this to kind of roll over and come back down again. Okay, so copper to gold ratio, I think this is a very bearish sign. You can see we've been in like a range from 2009 in this sort of range bounded by these two trend lines, almost a channel, not quite, because, well, it's not a parallel channel at least, kind of a broadening channel, I guess. We had a breakout here early this year, and then it turned out to be a false breakout. So for me, this is one of the worst indicators for the economy as a whole. Copper breaking down from this consolidation range. Might even be good to see, like, what does the S&P do around these breakdown levels? Let's go new price scale. So whenever this falls, I guess it's at least a measure of some degree of stagnation in the S&P. Yeah, I guess we saw, I'm not sure what kind of correction this was. But here, kind of went sideways on 2018 during this period. Well, I say that. Yeah, it was a very volatile time in the market. How about that? And then here, market went down while this was going down. So not a clear correlation here, but it's interesting to note. I don't think it's a good sign for the economy that that's happened. And you can see, at least in the 2008 crash, market crash, this thing really flushed down. So that's, I guess, my biggest worry is like a flush down of, month after month. That's probably correlates with the market crash. So what you want to look for is where's the point where it breaks consolidation. And to me, I think it's broken consolidation. So that's, I guess, what worries me the most. So looking at all of this, the thing that, like, there's a lot of things saying the market is breaking. That's my worry. But are they fixable? I don't think they're too far gone to be fixable. So the next couple days, I would say the rest of the week is going to be extremely important. I want to see recoveries if we're bullish on the market. I want to see bounces, strong rebounds in a lot of these different indicators. If that happens, then I think we're just fine in the market for at least a while longer. If it does not happen and we continue to flush down or just go sideways in a lot of these charts, then I'm pretty worried for the market and we might have a very strong correction. Or at the beginning of a very strong correction. So I guess that's all I really have to say. My next sort of position on this market is maybe 70% bearish biased, 30% bullish biased. It's a little bit, I was expecting the market to go higher. So I guess before this happened, or a lot of these things started breaking, I kind of expected a, pretty strong flush down just because of how steeply the market has been rising. Like if you just look, how often does this sort of rise happen in this amount of time on the S&P? It's not very often. Like this steepness happened during like the main recovery of COVID, and then the rest of the market was less steep. It's happened briefly before the 2020 crash. It happens during sort of V recovery bottoms, but it, like when you're breaking all-time highs, that doesn't happen. Like even going back to the dot-com bubble, this is pretty much, I guess, maybe on par with some of the like most extreme rises in the dot-com bubble. But yeah, this is like a serious move up, and that kind of demands a serious correction whenever it takes a pause. So that doesn't necessarily mean that's the end of the bull market, but I think it does mean at least a 10 to 15% correction around this period of time is expected. And I think after that, we just kind of have to see what happens next. I think a 10 to 15% correction might be enough for some of these other things that have started to break to bottom out. And yeah, I think we take it from there. So probably a month or two of pain, maybe less if it happens really quickly, and then we'll see.